Well, welcome everybody. We're at the top of the hour, so we'll get started. First, I want to start by saying good afternoon or good morning, everyone. On behalf of your Baird Financial Advisor, I'm excited to welcome you to this month's Baird Wealth Strategies webinar. Our topic today will focus around tax planning. The goal of the call is to educate you on the proposed tax law changes and the strategies that you might consider implementing now to minimize the impact of these changes. To present on these topics, we are welcomed by three highly regarded experts in the field. First, I'll introduce Erik Wikstrom, tax strategist. Erik recently joined Baird, and we are thrilled to have him as part of our team. Prior to joining Baird, he operated his own tax planning firm specializing in alternative retirement plan investments. Throughout his career in tax, Erik developed financial solutions to meet the unique goals of his individuals and institutions. Erik graduated from the University of Washington with a Bachelor of Arts degree in Business Administration and also holds a Master's of Science in Taxation from Golden Gate University in San Francisco, California. He holds a CPA and CFP designations, as well as life insurance and disability license in the state of Washington. Next, I'll transition to introduce Kelsey Clair, tax strategist, and joined our team in 2020. Prior to joining Baird, she was responsible for providing tax compliance and tax planning services to high net worth individuals and privately held businesses. Kelsey graduated from the University of South Carolina with both a bachelor's and master's degree in accountancy and a focus in taxation. Kelsey is a certified public accountant with the North Carolina State Board and certified public accountant examiners, as well as the Virginia Board of Accountancy. And last but certainly not least, we welcome Arti, Batra, senior estate planner who joined our team in 2020. Prior to joining Baird, she spent the last decade helping clients and their families achieve their estate planning goals. Her practice was largely focused on comprehensive estate planning, including tax planning for high net worth individuals, wealth transfer planning, estate and succession planning for business owners, and advising clients on asset protection strategies. Arti received her JD from Wayne State University and graduated from the University of Michigan. She is a member of the Financial and Estate Planning Council of Metro Detroit, the State Bar of Michigan, and the Probate and Estate Planning section of the State Bar. She also holds her Series 65. Thank you all for joining us. Now, before I turn the call over to you to begin the call, just a quick few logistical items I want to highlight. So for optimal viewing, we do suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner. All participants are in listen-only mode, but we'd really love to hear from you. So we will host a question and answer session at the end of today's call, and we'll address as many questions as time permits. To submit a question, you can simply do so by clicking the Q&A box on the bottom right-hand side of your screen and addressing your question to all panelists. And then lastly, this presentation will be recorded and be made available in about a week via your Baird Financial Advisor, as well as the slide deck that we'll go through today. So with that, Erik, Kelsey, and Arti, thank you so much for joining us. I'll now turn the call over to you, Kelsey. The floor is yours.
Great, thank you. And thanks again, everyone, for joining us today. We've seen quite a bit of tax legislation changes over the past few years, including the Tax Cuts and Jobs Act, Secure Act, CARES Act, just to name a few. But today we're going to be focusing on the American Families Plan Act, the 99.5% Act, as well as the STEP Act. It is important to note that these are all solely proposals and none of them have been signed. So on the income tax side, I'm going to start by running through a few of the credit expansions that were included in the American Rescue Plan Act, since the proposal has these expansions being extended either through a later date or permanently. And then I'll pass it over to my counterpart, Erik Wikstrom, to touch on the other two big tax increases included in the American Families Plan. All right. So the American Rescue Plan Act, and I'll continue to reference this as ARPA for efficiency, was signed in March of this year, and one of the credits expanded was the child tax credit. Usually, the partially refundable child tax credit is equal to $2,000 per child and is only allowed for children under the age of 17, but the ARPA increased the credit to $3,000 per child and bumped up the age restrictions by a year to include 17-year-old children as well. Children under the age of 6 are eligible for an even larger credit at $3,600, and the credit is fully refundable. So that means that the credit can create a refund even if you do not have a sufficient tax liability to offset. And finally, the IRS will calculate this credit based on your most recently filed tax return and pay half of it in advance starting in July. I think the first payment is supposed to come in July 15th. For those that believe they'll have a change in status, such as a new addition to the family or a substantial change in income, or those that just prefer to not receive these payments in advance, the IRS is going to set up a portal where taxpayers can update their information, similar to the portal that was provided for the stimulus payments. So there are 2 phase outs to this credit. The first phase out is on the amount that exceeds the $2,000 base credit. So for a child the age of 10, that would be $1,000, since the new credit would be $3,000 less the $2,000 base. This excess is phased out by $50 for every $1,000 that MAGI is above the limits listed here. Once that additional credit is calculated, the $2,000 base credit is phased out by $50 for every $1,000 that MAGI is above the $200,000 and $400,000 thresholds. Now, this phase out is the same that applied to the original $2,000 credit before ARPA. So let's run through an example. We'll assume a married couple, John and Jane Doe, with MAGI of $165,000 and 2 children ages 12 and 4. So prior to ARPA, the maximum credit that could be claimed is $4,000. That's $2,000 per child. And since their MAGI fell below $400,000, there wouldn't have been any kind of phase out, so they could have claimed the full credit. Now, under the new calculation, the maximum credit that could be claimed is $6,600. That's $30,000 for the 12-year-old and $3,600 for the 4-year-old. The additional credit of $2,600, which is the $6,600 less the $4,000 allowed under previous law, that's subject to this new phase out. Their MAGI exceeds the $150,000 threshold by $15,000. That multiplied by 5% equals $750. So the $2,600 additional credit is going to be reduced by that $750, leaving $1,850. The original credit of $2,000 per child is not subject to the second phase out since their MAGI falls below $400,000. So the total credit amount in this case would equal $5,850. Now, unless they utilize the IRS portal to change their information, they will receive $2,925 of this in advance in 6 monthly payments starting in July. I go through this example because the American Families Plan proposes to extend this credit through 2025. So those of you that have child dependents, you may see these advance payments for several more years. Now, another credit that was expanded was the Child and Dependent Care Credit. Usually, the non-refundable credit equates to between 20 and 30% of qualifying expenses. The maximum expense is $3,000 for one dependent or $6,000 for 2 or more dependents. The ARPA decreased the minimum percentage to 0 and increased the maximum to 50%. And it also increased the maximum expense on which the credit is calculated to $8,000 for one dependent and $16,000 for 2 or more dependents. And additionally, the ARPA makes this credit fully refundable. So just like the child tax credit, the child and dependent care credit is subject to 2 phase outs. First, the credit is reduced from 50% by 1 percentage point for every 2,000 of AGI that exceeds 125,000. That 125,000 applies to all taxpayers, regardless of filing status. And that percentage will not be reduced below 20% in this phase out. But then once AGI exceeds 400,000, that 20% is further reduced by 1% for every $2,000. So again, I'll run through an example to give you a better idea of the effect of this change. Let's look at the same married couple with MAGI of 165,000, 2 children, and let's say they incurred a total of 15,000 in childcare expenses. So prior to ARPA, an AGI of 165,000 would have reduced their credit percentage down to a minimum of 20%. Utilizing that 20% on the maximum expense for 2 or more dependents of 6,000, that equates to a credit of $1,200. Now, under the new calculation, we start at a 50% credit. Their AGI in this case exceeds 125,000 by 40,000. And remember, the percentage is reduced by 1% for every $2,000 that exceeds that amount. So that reduces the credit by 20% to 30%. Because their income falls below 400,000, which is the second phase out, the second phase out wouldn't apply at all. So their credit is equal to the 30% of the 15,000 in childcare expenses, which would equate to 4,500. So we're looking at a pretty drastic change from the $1,200 credit to a 4,500 credit under this new law. The new calculation applies to 2021 only, but the Americans Family Plan proposal wants to make these changes permanent. And so the last credit I wanted to cover is the ACA, or the Affordable Care Act Premium Tax Credit. So this is a refundable credit designed to help individuals, help eligible individuals and families afford health insurance purchased through the health insurance marketplace. The size of the credit is a sliding scale, and it's based on your income level. So those who have lower income will get a larger credit to help cover the cost of insurance. When you enroll in marketplace insurance, you can choose to have the marketplace compute an estimated credit that's paid to your insurance company directly, thereby lowering what you pay for your monthly premiums. In this case, you would reconcile that amount, the amount received in advance, with the allowed credit on your tax return, or you could alternatively choose to get all of the benefit of the credit when you file your tax return and not in advance at all. Now, prior to ARPA, the credit was available to those whose income falls between 100 and 400% of the federal poverty line. The percentage of income that households are expected to pay towards their health insurance coverage increases as their income increases. ARPA expanded the premium tax credit by broadening the income levels for which the subsidy applies, while also decreasing the percentage of income that an enrollee is expected to contribute towards their total premium. So here you'll see a table provided by the Kaiser Family Foundation comparing these percentages both before and after ARPA. Under the Affordable Care Act, households with income over 400% of the poverty line were ineligible for the subsidy entirely, but under ARPA, households are limited to only paying a maximum of 8.5% of their household income, even those exceeding the 400% of the poverty line. So again, to better illustrate this, let's run through a quick example. Mary Doe is age 60 and has household income of $51,100 per year. Under previous rules, her income is over that 400% federal poverty line, and therefore she's ineligible for the premium. The average premium for a benchmark silver plan is $957, and she would be expected to pay that full amount. Now, under ARPA, that same individual is expected to pay only 8.5% of her income towards her monthly premium. That equates to $362 per month. So her premium tax credit equals $595 per month, or $7,140 in total savings. This new calculation applies to 2021 and 2022 only, but the American Families Plan Act would make these changes permanent. Now, just to summarize, the proposal does extend the child tax credit expansion through 2025 and makes the child and dependent care credit expansion as well as the premium tax credit expansion permanent. Now, of course, there are a couple larger tax increases in this proposal, which I'm sure most of you are a little bit more interested in. So I'll go ahead and pass it on to Erik Wikstrom to discuss that further.
Thank you, Kelsey. Appreciate it. Hello, everyone. My name is Erik Wikstrom, and I'm going to be walking us through two of the major items found in President Biden's American Families Plan, which was released recently on April 28th, 2021, just a few weeks ago. So today we'll be looking at the potential, keyword potential, increases in capital gains taxes and ordinary income tax rates. But keep in mind that these items that I'll be talking about are only the Biden administration's proposed tax changes, and these changes are not law, and if and when items like this become law, they may be substantially different from what we know today. So let's focus first on capital gains taxes. Ordinary income rates apply to items like wages, interest income, IRA distributions, and Schedule C business income. But capital gains tax rates, on the other hand, apply when you sell an asset like a stock, bond, or mutual fund for a gain. And capital gains tax rates have traditionally been taxed at lower rates than ordinary income, but that may be changing. So as a reminder, capital assets sold for a gain owned less than 1 year create a short-term capital gain and are taxed at ordinary income rates. Capital assets sold for a gain owned for more than a year create a long-term capital gain and are taxed at long-term capital gain rates, which for 2021 are either 0, 15, or a maximum of 20%. Now, the American Families Plan, as proposed, would tax long-term capital gain as ordinary income for taxpayers with taxable income above $1 million, resulting in a top capital gains rate of 39.6%. So let's look at this chart for a minute, and let's focus on the two bar items on the far right. One is married filing joint current, and that's what we pay in capital gain rates today in 2021 based on your taxable income. So you either pay 0%, 15%, or the blue there is 20%, and the blue is unlimited. So you could have $10 million of income and your capital gain rates would be 20%. But the Biden proposal, the bar on the far right, is a married filing joint proposed capital gains rate schedule. And you can see at lower income levels, they're not messing when you go from the 0 to 15 or 15 to 20. But they're stopping the 20% rate for income. People with earned income above $1 million will now all of a sudden be taxed at 39.6 on their capital gains. Now, this example does not include the net investment income surtax, which was brought into effect with the Biden administration. And this surtax is 3.8% on net investment income above certain thresholds, $250,000 for married filing joint. So effectively, capital gains now, the maximum is 20% plus 3.8, 23.8. But with this new proposal, the capital gains rate could be as high as 43.4 when you add 39.6, the capital gain rate over $1 million, plus the net investment income tax of 3.8. So 43.4 is a lot higher than 23.8. So potential big changes on the horizon there. So let's look at a quick example that kind of isolates the difference, just so you can see this in dollar amounts. So if Jim and Sarah Smith had adjusted gross income of $1.2 million, and of that amount, long-term capital gains are $150,000. Currently, because of their income limits based on those prior table we looked at, they would pay a 20%, again, that 20% tax rate on capital gains, that's the maximum, that's unlimited. They'd pay 20% on $150,000 or $30,000. But if this Biden proposal goes through and this couple that has over $1 million in income, their capital gains of 150,000 would be taxed at 39.6. And again, let's not worry about the 3.8 net investment income tax, but the difference between 20% and 39.6, it's almost double, but they would go from owing 30,000 on a $150,000 capital gain to 59,000. So again, you can see a substantial increase for people potentially that make over $1 million a year or more. So let's take a look now at income tax. So we talked about capital gain, but let's look at the second top item that's in the American Families Plan proposal, which is income tax and how it could potentially be increased as well. So quite simply, this proposal does two things. It increases the top marginal rate from 37 to 39.6, and it lowers the thresholds for income levels to be taxed at these increased rates. So what does that mean exactly? Well, it means that we get there a lot sooner. So as you can see from either the single or married filing joint chart, the two on the left are single and the two on the right are married filing joint. The Biden proposal gets you to the highest ordinary income tax rate sooner, as you can see, at lower income levels, and it's more expensive. The higher tax rate increase would be another 2.6 from 37% to 39.6. So for a single taxpayer, comparing those two single columns, the single taxpayer would get to the top rate of 39.6 about $71,000 sooner than they did in 2021. And a married filing joint taxpayer would get to the top rate of 39.6. Again, the new supposed high tax rate, they'd get to that 39.6 rate about $119,000 sooner than they did in 2021. So not only is the potential for paying the top tax rate greater just because you're going to get there sooner. If they didn't keep the levels the same, they brought the income thresholds down to get you into a higher rate sooner. Now, if you focus on $400,000 there, you'll see that there's no change really between the single filers and the married filing joint. And that's part of Biden's proposal. He doesn't want to affect taxpayers making $400,000 or less for most of these concepts that he's come up with. So again, the 39.6 is only at higher rates, and anything under 400,000 does not look really to be affected as of this point. So what could you do? We've heard a lot about potential tax rate increases on both capital gains and ordinary income rates, but what might be some strategies to consider over the next few months, even though we don't have much knowledge on the specifics or the timing of when these proposals could even begin if they do become law. So what could you do in the interim? Well, what we could think about doing, and again, some items to consider with the assistance of your financial advisor, could be to accelerate income into 2021. And what are some easy things we could think about there? Well, one thing that comes to mind is if you have a traditional pre-tax retirement account, like a traditional IRA, you might want to consider converting some of that into a Roth IRA, because the amount that you convert from a pre-tax retirement account into a Roth is taxable income in the year of conversion. And so if we believe that rates are going to go up and you're in those higher rates, you might want to consider a Roth conversion in 2021. If you work for a company and you've been granted stock options and you have the type of option that is going to generate ordinary income when you exercise, you might want to consider exercising those in 2021 before the rates increase. Another thing you could do, obviously, if long-term capital gains are going to go up, or you think they are, or you believe that in a few months, you could recognize long-term capital gains in 2021 and not wait to 2022. On the other side, you could defer deductions into 2022. You could do what's known as tax loss harvesting. You could take some positions where you've got built-in losses and match those with some gains, as opposed to doing some in 2021, do it all in 2022, so you don't have more income in 2022. Potentially, you could make tax deductible payments in 2022, like property tax payments or business equipment purchases if you own a business. You could also consider deferring charitable contributions and not making them this year, or making the majority of them into 2022, where you're going to get more bang for your buck at the higher tax rate. So in closing, we've talked about proposals. Nothing is certain yet. A lot will transpire over the summer, over the next few months. As we know, proposals can change drastically between the House version, the Senate version, and what ultimately becomes law. So stay in contact with your financial advisor and continue to have discussions on how these potential changes could affect your financial situation. Everyone is different, and no strategy fits all. Okay, at this point, I would like to pass the baton over to Arti Batra, and she will continue on with proposed estate tax law changes.
Great. Thank you, Erik, and thank you, Kelsey. Okay, so let's shift gears now and take a look at the proposed estate and gift tax law changes. Most of what we will be discussing is laid out in the Sanders bill, also known as the 99.5% Act. Now, if you've heard anything about this, you might know that if this bill passes, it would basically lead to a greater number of estates that would owe an estate tax, as well as increase the total amount that they would pay. But that's only part of it. There are additional proposed changes that you need to be aware of, so let's take a look at all of this in more detail. Okay, so this next slide here gives us an overview of what might change. And we are looking at the following. We're looking at a reduction of the estate tax exemption and an increase in the overall rate, a reduction of the lifetime gift tax exemption, a limitation on annual exclusion gifts, and then finally, an elimination and or reduction of the cost basis step up. And this last part is actually addressed in the STEP Act or the Van Hollen bill. So let's start our discussion with addressing changes to the estate or death tax. Now, for those of you that are not familiar with this, you should know that there is a limit on the amount of assets that you can pass at your death to anyone that is a non-US citizen spouse. Anything over that limit or exemption will be subject to a tax, and that exemption today is 11.7 million. Now, if you're married to a US citizen, then it's unlimited, but this is for assets passing to anyone that is a non-US citizen spouse. If we look back at the history of the estate tax exemption over the last decade, and this might be helpful because it'll provide a little bit of context as we anticipate the future, but if we go back a bit, let's go back to 2010, which was an unusual year. Now, most people remember 2010 as the year that there was no estate tax, but actually your estate or your heirs had a couple of options. They could either pay no estate tax, but then pay capital gains tax on appreciated assets, or they had the option of paying an estate tax on anything over 5 million, but then also getting a step up in basis for those appreciated assets and avoiding a capital gains tax. As I mentioned before, most people really just knew this as the year that there was no estate tax. Then for the years 2011 and 2012, the estate tax exemption went to 5 million adjusted for inflation. For the year 2013, it was set to go back down to 1 million, but that didn't happen. Instead, the exemption became permanent at 5 million adjusted for inflation, and it also made portability permanent. And I'll talk about portability in a few minutes. Then 2018 rolled around, and the Tax Cuts and Jobs Act was passed, and that essentially doubled the exemption from 5.6 million to 11.2 million overnight. Now, that was only intended to be for a limited time period. And so at the end of 2025, our exemption is set to go back down to that 2017 level, which when adjusted for inflation is probably going to land at around 6 million. Now, if the Sanders bill passes, then the estate tax exemption could be lowered a lot sooner than the end of 2025, and the exemption itself could be a lot lower than 6 million. So let's take a look at what that might be. Okay, I mentioned earlier that currently each person has an $11.7 million exemption. And if you are married, then collectively with your spouse, you can pass up to $23.4 million estate tax free. Under the Sanders bill, we are looking at the exemption going down to $3.5 million for a single person and then $7 million for a married couple. There would be no recapture on any previously used exemption, meaning if you have made large gifts and you have used a good portion of your current exemption, then under this proposal, your exemption will be the greater of what you have already used or the current exemption in place. Also, if you've ported any exemption from a deceased spouse, that will also not be reduced. Now, if you're not familiar with portability, it really just means that if one spouse passes, then any unused amount can be transferred to that surviving spouse. For example, if your spouse passed away yesterday and did not use any of their exemption, you can elect to have their $11.7 million exemption added onto yours. Now, looking at rate changes, currently our rate is 40%. That means that anything above 11.7 million going to a non-US citizen spouse is subject to a 40% tax. Now, under the proposed changes, as you can see here, that rate would increase as the value of the taxable estate increases. So now we're actually starting at 45%, and then you can see it climbing up, maxing out at 65% for those very large estates. So let's look at a few examples of how different clients might be affected by these changes. And so first we have our hypothetical clients from before. We've got John and Jane Doe, and we're told that their estate is valued at $25 million. Now, under the column titled Current, this shows how much tax their estate would owe if, as morbid as it sounds, if they both passed away yesterday. And in our example here, after their exemptions are applied, there is 1.6 million remaining that would be subject to an estate tax. And that tax here is about $640,000. Now, the middle column tells us what would happen if the Sanders bill gets passed. Well, now our exemption goes down to $3.5 million. And after we apply both John and Jane's exemption, we have 18 million remaining that would be subject to an estate tax. And that tax is pretty significant here at just under 8.7 million. Our last column here shows us what would happen at the sunset, assuming that the exemption does not get lowered before then. And here you can see that there would be about 13 million subject to an estate tax. And then at a 40% rate, that tax would be around 5.2 million. Okay, in our next example, we have Jack and Anna Smith, and we are told that the Smiths have an estate valued at 10 million. Now today, there would be no estate tax due, and under the sunset provision, there would also be no estate tax due because that exemption is large enough to cover their estate. But under the Sanders bill, there would be a tax. After we apply both Jack and Anna's $3.5 million exemption, there is still 3 million remaining that's subject to a tax. So you can see this is a great example right here of how the Sanders bill would essentially result in a greater number of estates subject to an estate tax. Okay, our last example here, we've got Jim and Sarah Brown, and we're told here that they have an estate valued at $6 million. Now you can see here that there would be no estate tax owed under any scenario. And so based on this, if you are under that $6 to $7 million amount, you probably don't need to worry about the estate tax in the near future. But for those estates that are over that amount, you may want to evaluate some planning options with your attorney or your advisor. Okay, moving on now, let's look at possible changes to the lifetime gift tax exemption and the annual exclusion. So currently, our lifetime gift tax exemption is the same as the estate tax exemption at 11.7 million. Now, the proposal here would reduce that lifetime gift tax exemption amount to 1 million. So that's a big change. That means going forward, anything over 1 million would be subject to a gift tax. Today, we still have that 11.7 million, but if we don't use it, then any unused gift exemption would be lost after the effective date. Now, for those individuals that have already gifted, there would be no recapture. There also may be a capital gains tax on gifted property. Now, this part, different than the Sanders bill, this part is actually set forth in the STEP Act or the Van Hollen bill. There would be an exclusion on the first $100,000 of gains, but anything over that amount would be recognized. And we're going to come back to the STEP Act in a few minutes. If we go back to our clients, John and Jane Doe here, we can see an example of how Jane might owe a gift tax after the effective date. Now, if Jane gifts $3 million today, there would be no gift tax due. Remember that $3 million counts against her lifetime gift exemption of $11.7 million. But if she waits until after the effective date, well, now she can only gift $1 million tax-free, and that remaining $2 million would be subject to a gift tax, and that's pretty substantial here. It's a good portion of the gift. Okay, another major change we're looking at is a limitation on annual exclusion gifts to certain entities, such as trust, family limited partnerships, or LLCs. And that limit would be $30,000 per donor. For those of you that currently have an annual exclusion gifting strategy into trusts or other entities, please keep this in mind. Now, if you give gifts outright, then this will not affect you. So if we go back to our friends John and Jane Doe here, let's take a look at how this might affect them. Today, they can gift $15,000 each to a trust. And if they wish to make a gift to 3 irrevocable trusts, collectively, they can gift a total of $90,000. However, if the proposed changes are passed, now their total gift would be reduced to $60,000, and so each trust now gets $20,000. This could be an issue for those of you that have irrevocable life insurance trusts, and if you need to make substantial gifts into those trusts to cover the premiums on the policy, this might be an issue. One way you could get around this might be to reduce the size of the death benefit. Maybe you could look at a different policy with a lower premium. Another way might be to bunch your gifts into that irrevocable life insurance trust before the effective date. And I'm going to come back to that concept a little later on. Okay, I previously mentioned the STEP Act. Let's look at that now in a little more detail. And remember, this was introduced by Senator Van Hollen. This bill proposes to eliminate the step-up in basis for inherited property. So that means going forward, there would be no step-up in basis to fair market value at death, but rather beneficiaries or heirs would inherit the previous owner's cost basis. Additionally, property transferred by either gift or at death is treated as a deemed sale, which would then cause gain recognition. Now, we talked earlier about capital gains tax on transfers during lifetime, and we said that there would be an exclusion on the first $100,000 of gain. For transfers at death, there would be a $1 million exclusion on gains, and then anything over that amount could be subject to a capital gains tax. Now, there are some exceptions, and that includes property that's donated to charity, as well as family-owned businesses and farms where the business is transferred to heirs who then continue to run it. So let's take a look at an example to see how this might work. And here we have Patricia. She passes away and she leaves her stock to her daughter. Now, at her death, we're told that Patricia's stock is valued at $3 million and she has a cost basis of $1 million. Today, there would be no tax owed as her daughter inherits the stock at fair market value. But under the Van Hollen bill, there might be a pretty hefty tax. Under that bill, Patricia's daughter would inherit the property at Patricia's cost basis, so $1 million. And then she might be forced to recognize that $2 million gain. Now, although she has her $1 million exclusion, she still has another $1 million of gains that she has to pay tax on. And in this example, that tax amounts to $434,000. Okay, so now that we've talked about some changes, what can we do to prepare? Let's take a look at some very general planning strategies. Now, I just want to note here that there is no one size fits all. Your planning is going to depend on a number of things, including the types of assets in your estate, the circumstances of your beneficiaries, and of course your goals and wishes. So with that in mind, let's take a look at these very general planning strategies. And these include making lifetime gifts, paying for medical or educational expenses, making charitable gifts, and then finally we will talk about a spousal lifetime access trust. So first, let's talk about gifts. Think about using your annual exclusion. Today, the annual exclusion amount is $15,000, And again, that means you can transfer up to $15,000 to a person without having to use any of your lifetime gift tax exemption. And if you are married, you can double that to $30,000 with your spouse. Also, think about making large gifts and using your lifetime exemption. We talked about this earlier. If you make large gifts while you still have your $11.7 million lifetime gift tax exemption today, there will not be any recapture of what you have gifted if and when that exemption bumps down to 1 million. And then also consider bunching your gifts to anticipate for a possible reduction of the lifetime gift tax exemption. So let's look at an example of how we could bunch our gifts. And we're going to go back to our friends, John and Jane Doe here. In this example, we are told that they have a gifting program of $100,000 each year. They've used up $900,000 of their exemption. If they continue with their gifts this year, and then at some point that lifetime gift exemption goes down to 1 million, well, now they've maxed out their exemption, and then they would owe a gift tax on any assets they gift. So instead of gifting the $100,000, what they might want to do here is give $400,000 to bunch the next year, 4 years worth of gifts. Now, if they make this gift before the effective date, they would owe no gift tax as it would be applied against their $11.7 million lifetime gift tax exemption. Another thing to think about is making payments directly to medical facilities for healthcare expenses or to educational institutions for tuition. Now, these are not taxable gifts and they do not count against your annual exclusion amount or your lifetime exemption. Just remember that you have to pay the institution directly. So if you have children or grandchildren that are in school, this is a great and relatively easy way to move some of those assets out of your taxable estate. Another thing to think about is making lifetime gifts to charity and either increasing or bunching these gifts. Now, by doing this, you remove the assets from your taxable estate, and then you could also get an income tax deduction. Also think about making a qualified charitable distribution from your IRA. Now, once you reach age 70 and a half, you can make donations of up to $100,000 to a qualified charity directly from your IRA. So if this is done correctly, that distribution is not taxable income. For many taxpayers, this results in a lower tax liability as opposed to withdrawing from the IRA and then donating the proceeds to charity. And then finally, think about naming the charity as a contingent beneficiary on your account. Now, at your death, this gives your primary beneficiary some flexibility, and they can decide whether it's best to take that account or to disclaim it, let it pass to the charity, and thereby reduce your taxable estate. Okay, for our final strategy, let's take a look at a spousal lifetime access trust, or a SLAT. A SLAT is basically an irrevocable trust where one spouse makes a gift into a trust for the benefit of the other spouse while removing the assets from their combined estates. Now, some things to keep in mind if you are considering a SLAT. You have to note this. You must make sure that you're funding the SLAT with your separate property. Or if it's marital property, then your carved out portion of that marital property. Your spouse can serve as a trustee, but distributions must be limited to health, education, maintenance, and support. Now, you can indirectly benefit from that SLAT as long as your spouse is living and you stay married. If your spouse passes, then the trust assets will pass to your children or whoever you name as a beneficiary, and then you will no longer have access to those assets. Now, if that might be an issue, then perhaps both you and your spouse may want to think about creating SLATs for each other. Just be careful in drafting these and make sure that they're somewhat different so that the IRS doesn't perceive them as being constructively similar, undo them, and then pull the assets back into the respective donor's estate. So we have a diagram here that illustrates how the SLAT would work. And you can see at the top here, one spouse has funded their entire exemption, $11.7 million, into this SLAT. Now, while the beneficiary spouse is living, both spouse and descendants have some access to the principal. Now, assuming that the assets grow 4% annually and that there have been no distributions of income or principal, and the spouse lives for 20 years, you can see here that at the spouse's death, there is almost $14 million of post-gift appreciation that is excluded from that first spouse's taxable estate. So that amount plus the original amount then would be equally divided. In this example here, it's equally given to each of their 4 children. And now they have just passed a substantial amount estate tax free. Okay, so that brings us to the end of this portion of our presentation. We hope that you have found this helpful. And for those of you that might be affected by some of these changes, we hope it's given you some ideas to start planning. I'm going to pass it back to Kelsey for some questions.
Fantastic. Thank you, Arti, Kelsey, and Erik for your comments. I'm just going to take a moment before I dive into questions and remind everybody, if you'd like to ask a question, please do so via the Q&A button on the bottom right-hand side of your screen. We've seen a ton of questions come in, and so if we have tried to bucket some of the questions a little bit more generally, and so we'll take the first couple as we go. All right, Kelsey, I'm going to have the first question coming to you, and that is there an income cap for the child tax credit changes?
So there is an income cap on the total tax credit, but that which is like the $2,000 original credit, that is subject to the same limitations that was there previously. So once your income hits $400,000, that $2,000 credit starts to phase out. For one dependent, it would be fully phased out at $440,000. There are income caps on the new credit, I guess, the amount over the 2,000 originals, so 1,000 or 1,600, depending on age. And let me just read those amounts once again. Those thresholds are $75,000, $112,500 for head of household, and $150,000 for married filing jointly.
Thank you. I'm going to keep the questions coming to you to start with. So the next question that came in is, my daughter turns 18 in November, so she was 17 on my 2020 return. Do you think the IRS will correctly determine that she doesn't qualify for the child tax credit when issuing the monthly credit payment starting in July?
So if she was 20 on the if she was 17 on the 2020 return, then she wouldn't have been eligible for the credit in 2020, since under old rules, it's under age 17. So I wouldn't expect the child tax credit box to be marked on your 2020 return, and therefore the IRS wouldn't be calculating that credit for her.
Great, thank you. Next question, is there any information available regarding the advance payments of the child tax credit to an individual who is no longer able to claim a minor child? As an example, diverse taxpayers who switched years claiming a child. Will the advance payment need to be reconciled on the 2021 tax return?
So in that situation, you'll likely want to keep an eye on the IRS website. They will be putting out a portal of sorts where you can update your information based on your last filed return to identify that you are no longer claiming that child for the 2021 tax year, and to not have them send you advanced payments. If you do receive those advanced payments, if you didn't go on the portal and request that it not be sent, then yes, you would have to reconcile that on your 2021 tax return and likely pay it back.
Fantastic. Will the child tax credit payments be automatically sent to eligible recipients, or do you need to sign up with the IRS somewhere? And if you would prefer to get these tax credits applied to your tax bill rather than getting payments, how do you go about doing that?
So kind of same situation. If you do want the advanced, they're going to automatically, based on your recently filed return, calculate the advanced payments and go ahead and send them out starting in July. If you do not want the payments, or you have a change in filing status, that's when you're going to want to go online onto their portal and make that indication so that they do not send the payments or alter those payments.
Great. What about, will clients making less than $400,000 get a cash credit in July?
I'm not quite sure what they could be referring to there. Maybe they're referring to a stimulus payment, but there were no stimulus payments in this in the proposal nor in the last bill passed. If you're referring to the child tax credit, yes, if they very well might be getting advance payments of those child tax credits if their income is below 400,000, but not fully phased out based on those new income thresholds.
Great. Since any excess amounts of the child tax credit advance payments must be repaid, is it wise to take the payments, or would it be better to decline the early payments? The potential for repayment is especially concerning considering we typically have to pay additional taxes when we file.
So I'd say it's very dependent on your specific situation. Unlike the stimulus payments, if you are given advanced payments of this credit and you're not eligible for them, they are required to be paid back. There is a safe harbor provision out there where if you don't have a certain amount of, if you have less than a certain amount of income, you don't have to pay back $2,000 per child. But that only applies, I think, for married couples. That only applies for AGI of less than $60,000.
All right, and then this couple is expecting a baby in August. Congratulations. Do we have, or do they have a URL for the portal?
So there is a specific website up there right now for the child tax credit for 2021 on the IRS website. Right now it just says, keep an eye out for further information regarding entering changes. So there is no portal yet, but I imagine there will be one here shortly, especially with the payments coming in about a month.
Great, thank you. I'm going to spread the wealth a little bit. Erik, I'm going to transition the next few questions to you. The first one, are the income limits earned income or AGI, i.e. can include the amount in cap gains? Can you include the amount in capital gains taken? Does the capital gains count towards your AGI?
So the income limits are a function of AGI, and this is a capital gains question, so adjusted gross income. The capital gain is included in your adjusted gross income, yes.
All right. Has there been any discussion about holding the cap gains rate to a lower rate for one-time large income years, such as when we sell or buy a business?
Unfortunately, I have not seen anything that indicates you can get a one-time pass on this. In the Biden administration publication on 428, they talk about on the step up, the reform will be designed with protections for family-owned businesses and farms, but that's a step-up issue and not a capital gain issue. So I have not seen anything that would exempt one-time events from capital gain higher rates.
What about, does capital gains proposal include real estate?
Well, it would, but one thing to point out is everybody would still get the personal residence gain exclusion. So if you're a single filer, you get a gain exclusion of 250,000 as long as you've met some 2 out of 5 year rules. Married filing joint, that number is 500,000. So the first thing you do is chew up your personal residence gain exclusion, 250 or 500, depending upon your filing status. And then the rest of the capital gains would go into that capital gain calculation. So effectively, real estate is included as part of that.
Thank you. And then has there been any word on the capital gains ordinary income changes being retroactive?
I wish I had a good answer for this. I've seen some information where they think the capital gains changes could be retroactive to April 28th. There's a lot of thinking that administrations don't like to do retroactive changes. That has happened over time, but generally tax law changes are prospective, meaning in the future. So it's hard to tell. I have not seen anything, and we may get word here in the next few months. I believe Congress has a recess the end of August. So this could be a very busy summer period, and we may learn more about the timing of these changes and when they're effective.
Great, thank you. I'm going to transition now to Arti for a couple of questions. Since you specifically said non-U.S. citizens, a resident alien spouse would be taxed on inheritance? As a question.
So that unlimited marital deduction is only between U.S. citizen spouses. Now, what the non-citizen spouse could do, they could defer the taxes, and that's done through a QDOT. It's a special type of trust. Also, if there is they could also check to see if there's a treaty in place that would allow some level of marital deduction. But generally speaking, that unlimited marital deduction is available typically between U.S. citizen spouses.
Great. Do you expect the unused exemption from a deceased spouse to continue to be available for the surviving spouse? Would it be reduced or less the amount computed on the deceased spouse estate tax return?
We expect it to be there. We haven't heard anything otherwise. That what they really mean here is portability. We haven't heard anything saying that portability would not be available. When that first spouse passes away, the surviving spouse does have to make an election on that estate tax return, electing that they are going to have portability and transfer it over to their estate. As we know so far, that has not been eliminated.
And then is there a no step-in basis at death? If there is no step-in basis at death, is the property for estate purposes valued at cost basis?
Typically, yes. That's what we would imagine. They would get carryover basis. There might be modified carryover basis as well, but it would be some version of that. Essentially, we would get no step up in basis to taxable value or fair market value at death.
And then what do you think the chances of changes to estate gift taxes being retroactive to 1/1/2021?
That's an interesting question. We haven't seen anything indicating that it might be retroactive. We're operating under the assumption that there's going to be an effective date, and at that point, everything would change. I think it would be chaos if it went retroactive. I just don't see it. And again, we haven't heard anything implying that it might be retroactive. But I can't speak to the chances. Anything's possible. Anything could change.
What about, is tax due on the proposed change to step-up basis is only due once the taxable event occurs, selling the asset, or immediately the year the death occurred?
So what we're hearing from the STEP Act or the Van Hollen bill is that there would be forced gain recognition. So you would basically, it would be treated as a sale. And so that tax, that capital gains tax, would be due immediately as it transfers. We don't know if that's how it's going to be implemented. It could be that maybe it's just a carryover basis. We don't know, but that was laid out in the Van Hollen bill.
All right. Is setting up a joint account with an IRS-approved educational institution result in a dollar-for-dollar charitable deduction from the estate?
That's going to be more dependent on how they're doing that, and it's probably going to be a question for their CPA to answer. I think that's something they'll have to take back and look at their specific situation and have their advisor and their CPA see if that's possible.
Okay. You didn't necessarily discuss CRTs as beneficiaries on IRAs. Any comments on that?
You could absolutely set up a trust as the beneficiary, charitable remainder trust or CRUT or CRAT. You could do that as well, and that would be a great way to take down the taxable value of your estate. There's different options around that. We talked about strategies. We were talking about very general planning strategies, but that is a great strategy for someone that is charitably minded and that has those assets that would be appropriate for that. So my thoughts would be, yes, if you're looking at donating to charity, that's a good route to go, and it might be something to further explore with your attorney or your advisor.
All right. For lifetime gifting, do you use your DSUE first before you use your lifetime exclusion?
You should be burning through that DSUI first, what you've collected from a deceased spouse, and then go to yours, only because if that changes, if it bumps down any, that what you have set in stone from your deceased spouse is gonna be better served using that first, and then what you can, if you made a gift and that cut into your lifetime gift exemption, remember, you're going to get the greater of what you have already gifted or what it's currently in place of that $1 million. So it's better to use the DSUI.
All right, and I know we're at time, so I might just ask one more question before we wrap up. And that is, I am planning to make a charitable contribution directly from my retirement funds. Can I begin doing so at age 70 and a half, or has it been changed to 72 or 72 and a half?
No, it's still 70 and a half. I know we've seen some changes around IRA distributions because of the Secure Act, but for the qualified charitable distribution, it's still 70 and a half. You can go ahead and make that contribution directly from your IRA. And just be mindful, though, it can't be any portion. You have a $100,000 limit, and it can't be anything that you have just gifted or you've just contributed to. So if you've been retired, go ahead and make that. It shouldn't be an issue.
Well, great. Arti, Erik, and Kelsey, thank you so much for your candor and your comments as we enter the Q&A session. Everybody on your line, thank you for your questions coming in. There were questions that we were not able to get to, and so I would encourage you to reach out to your financial advisor, and they'll get in contact with the appropriate expert here on the call to make sure that your answer is answered correctly, or if you need any clarifying questions, certainly reach out to them as well. I'd also like to remind everybody that this presentation today has been recorded and will be made available in about a week, so the middle to the end of next week, through your financial advisor. Both recorded and the deck will be made available. With that said, we hope that you join us for our next Baird Wealth Strategies webinar, which will take place in August, and will be on the topic of Social Security. We greatly appreciate you attending today. Presenters, Arti, Erik, Kelsey, thank you for your expertise. We look forward to seeing everyone soon. Take care.